Welcome to the deep dive. Today, we're going straight into the potential economic shifts following the 2024 U.S. election.
Right?
Donald Trump is heading back to the White House, and, well, the Republicans have control of both the Senate and the House now. So, what could this mean for the economy going forward?
Yeah, there's some really interesting analysis out there. We'll be looking at recent reports from EY and the London Business School to try and understand the potential changes we might be looking at.
Absolutely. And our goal for you today is to, look beyond the immediate headlines. We want to understand the key economic areas that could be affected, maybe the scale of these changes, and what it all might mean for you, both near term and maybe longer term, too.
Okay.
Okay, so let's unpack this. One of the first things that really jumps out from the EY analysis is this apparent disconnect, between how voters felt about the economy and what the actual economic data was showing before the election.
That's a really crucial place to start, I think. Exit polls, they showed the economy and, yeah, especially inflation were top concerns. Lots of voters reporting financial strain. And this was despite, well, seemingly positive signs. GDP growth was 2.7% in Q3 2024, unemployment pretty low at 4.1% in October, and CPI inflation was actually down at 2.4% in September.
So what explains that gap between the numbers and how people felt? The EY report mentions something called cost fatigue.
Right. Cost fatigue.
It sounds like it's not just about the rate of inflation right now, but the sort of cumulative effect of prices going up over years. They mentioned the CPI being up, 22% since December 2019. That really hits home when you think about it that way, doesn't it?
It absolutely does. I mean, people are feeling that sustained hit from higher prices on everyday things. That cumulative burden, it just likely outweighs the latest, monthly inflation figure in how they view the economy.
Yeah, you can see how that feeling would shape voter priorities.
Definitely.
Okay, now let's look at the markets. How did they react right after the results came in? EY talks about a pretty immediate Trump trade response.
Yes, and what's fascinating there is how quickly expectations shifted. The idea of stronger growth, maybe bigger government deficits, it really moved markets fast.
Like what? What moved?
We saw Treasury yields jump up, meaning borrowing costs rose. At the same time, stocks, both large caps in the S&P 500 and smaller caps in the Russell 2000, they saw gains. And the U.S. dollar got stronger, too.
But as EY also points out, some of those initial moves didn't really stick around for long.
That's a really important point. By the end of that election week, yes, some of those Trump trades had already started to ease off or even reverse.
Why do you think that happened?
Well, it likely reflects, maybe an initial overreaction, and then the market starts digesting the more complex reality. Policy takes time to implement. There could be hurdles in Congress. It just highlights the uncertainty that always follows these big political shifts.
Okay, so what does this mean for the near-term economy then? Are we expecting big immediate shifts?
The general feeling from EY seems to be, look, the U.S. economy has pretty solid momentum right now. So major impacts right away, like in the first half of 2025, from policy changes in areas like, say, immigration or regulation. Probably marginal.
Okay, so some stability, at least initially. But the bigger changes, they're expected further down the line.
Exactly. The more significant consequences, those are likely to come from changes in tax and trade policy. But those impacts, they probably won't be really visible, until maybe early 2026. It's expected to be more gradual.
Gradual. The EY analysis also mentions some competing forces at play in the near term. What are they talking about?
Yeah, so on one hand, you could have looser financial conditions, maybe driven by market expectations about certain policies, and that could encourage businesses to invest more.
Okay.
But on the other hand, you've got this increased policy uncertainty that always comes with big transitions. And that might make businesses hesitant, sort of hold back on activity while they wait for more clarity, bit of a push and pull.
Right, waiting to see how things shake out. Okay, let's dig into some specific forecasts then. How does EY see the baseline economic projections changing now, post-election? GDP growth first.
Sure. EY has nudged its real GDP growth forecasts down slightly. For 2025, they're now thinking 2.0% growth, just a modest tweak.
And beyond 2025.
The reductions get a bit more noticeable then. They're expecting 1.7% in 2026 and 1.8% in 2027. So suggesting a bit more of a slowdown further out.
Okay. And what about inflation? That was a big one for voters.
Their revised projections for CPI inflation, they show a marginal increase in the last quarter of 2025, maybe hitting 2.3%. By the end of 2026, they see it a bit higher, also around 2.3%. So, yeah, An expectation of some upward pressure on prices.
And how does all that, the growth outlook, the inflation outlook, how does that feed into what the Federal Reserve might do with interest rates?
Yeah, that's the crucial link between fiscal policy, government stuff, and monetary policy from the Fed. Given that expectation of slightly higher inflation, EY is now thinking the Fed will make fewer interest rate cuts in 2025.
Fewer cuts. How much fewer?
They're now projecting about 100 basis points of cuts in total, which is down from the earlier forecast of 150 basis points. So that would leave the main policy rate, the federal funds rate, around 3.4% at the end of 2025. Suggests a less accommodative Fed.
Okay, shifting gears a bit. Tax policy, always a big topic. The potential extension of those 2017 tax cuts, the TCJA, that seems pretty likely now with Republican control, right?
Absolutely. Those cuts are set to expire. And yeah, with Republicans controlling Congress, extending them seems like a strong possibility. UI points out they could use budget reconciliation to do it.
Remind us quickly what budget reconciliation is.
Sure. It's basically a legislative fast track in the Senate, allows them to pass certain budget-related bill spending, taxes, debt limit with just a simple majority, so they don't need 60 votes to overcome a filibuster. Makes it much easier to enact fiscal policy changes if one party has control.
Got it. And EY also mentioned a risk if they didn't extend them, a fiscal cliff.
Exactly. If those tax cuts just expired suddenly, it would mean higher taxes for many, potentially leading to a sharp drop in economic activity. That's the fiscal cliff they're warning about avoiding.
So assuming the extension happens, what kind of economic boost is EY factoring in now?
Okay, so their baseline forecast now builds in about a 0.3% lift to GDP by mid-2026, just from fully extending the TCJA.
Okay.
And then they add another 0.1% boost from bringing back 100% bonus depreciation for business investment and allowing immediate write-offs for R&D costs. So altogether, maybe a 0.4% lift to GDP from these tax measures by 2026-2027.
But it's not a done deal yet, is it?
No, definitely not. As EY is careful to say, these are just baseline assumptions. The final shape of tax policy could look different depending on negotiations in Congress. Lots of possibilities still.
And there's also talk about the corporate tax rate, maybe cutting it from 21% down to 15%. What's the thinking on that?
Yeah, that's another potential move. The idea is that a lower corporate rate would encourage businesses to invest more, maybe hire more. EY's analysis suggests cutting it to 15% in 2026 could add another 0.1% to GDP that year, maybe 0.2% cumulatively by 2027.
But there's a cost, right? The deficit impact.
Oh, absolutely.
Yeah.
EY notes the Congressional Budget Office estimates that kind of cut would add about $800 billion to the deficit over 10 years. So there's a definite trade-off there.
Okay, moving on to government spending. Sounds like it's more of a wait-and-see situation there.
That seems to be the prudent approach, yeah. EY isn't really building specific campaign promises into their forecast yet. It makes sense to wait and see what priorities actually emerge in Congress and what specific spending bills look like.
But they did mention some potential areas that were talked about during the campaign.
Right. Things like potential tax breaks for tips or Social Security wages, overtime pay. Also possible cuts to agencies like the IRS, the EPA, Department of Education. But at the same time, there was talk of protecting Social Security, Medicare, defense spending, and maybe revisiting the Affordable Care Act. It's all still pretty speculative at this stage, hard to pin down the economic impact without concrete proposals.
Yeah, like figuring out the effect of less environmental regulation, that's complicated. Depends on the specifics.
Exactly. Business costs versus other potential effects. Needs detail.
Okay, trade policy. This is another area where big changes are expected. Trump's stance on tariffs is pretty well known. What's the likely approach this time, according to EY?
Well, EY is anticipating maybe a more gradual, more targeted approach this time around, rather than just broad across-the-board tariffs immediately.
Targeted how?
They expect tariffs aimed at specific sectors, potentially from places like China, Europe, Mexico, Canada, but used more like a tool, transactionally, leverage to get concessions on trade, maybe immigration, other political goals.
Can you give some examples? What kind of tariffs are we talking about?
Sure. They mentioned things like steel and aluminum, maybe 10 to 25% tariffs. Autos, especially from Europe, or maybe China-made cars coming from Mexico, again, maybe 10, 25%. And then other goods, dairy, electronics, chemicals.
And retaliation.
Oh, yeah. They fully expect other countries to hit back with tariffs on U.S. goods. That's almost always part of the equation.
And when might we start seeing the economic impact of these targeted tariffs?
Well, there's usually a procedural lag. EY reckons it could take 9 to 12 months from announcing trade actions to them actually taking effect.
Yeah.
So they see a gradual drag on GDP starting maybe late 2025, building up to about a 0.6% reduction by the end of 2026.
Okay, 0.6% drag. But the idea of really broad tariffs, that sounds like a much bigger deal. The London Business School analysis also flagged this as a major uncertainty.
It is indeed. EY also ran a scenario looking at much bigger tariffs, like 60% on everything from China and a 10% universal tariff on all imports, assuming other countries retaliate proportionally.
Wow. And the economic hit from that kind of scenario must be pretty severe.
Extremely severe, yes. EY's modeling suggests that could knock a huge 2.5% off U.S. GDP after 2 years.
2.5%, that's massive.
It is. Plus, it could push inflation up by 1.2% after just 1 year. And they estimate an average household income loss of around $1,145. Importantly, they point out lower-income families would likely be hit hardest by that kind of tariff shock.
And globally.
Big impacts there, too. Significant GDP reductions for major trading partners like China, Mexico, Canada. It would ripple outwards.
Okay, let's turn to immigration policy, another area where changes are expected. What's anticipated there, and what are the potential economic consequences?
EY expects pretty immediate restrictions at the southern border, probably requiring asylum seekers to wait in Mexico while their cases are processed.
And how does that affect overall migration numbers and their forecast?
Their new baseline assumes net migration drops from about 1.1 million people per year down to around 900,000.
Okay, a reduction of about 200,000 per year. How does that impact the economy?
Well, immigration has actually been a pretty big driver of recent growth in the labor force and employment. So reducing that inflow is expected to weigh on GDP growth a bit in the short term, maybe a 0.1% drag after a year.
And inflation.
Potentially upward pressure there too. As EY notes, fewer immigrants could tighten the labor market again, which might push wages and prices up.
But they're not assuming mass deportations or anything like that.
No, they emphasize that their baseline doesn't assume that, nor does it assume severe cuts to legal immigration. Those would be additional downside risks if they happened.
Got it. Okay, let's talk about the budget deficit. It's already pretty big. How do all these potential policy changes affect the fiscal picture?
Yeah, the deficit was already substantial, $1.8 trillion in fiscal 24, with national debt over 100% of GDP. Even before these changes, projections showed deficits rising, largely due to increasing interest payments on that debt. And EY points out that just extending the TCJA tax cuts could add another 11% to 14% of GDP to the debt by fiscal year 2035. That significantly worsens the already concerning long-term fiscal outlook. The London Business School also highlighted that extending the tax cuts adds to the deficit.
So bigger deficits, more debt. Okay. What about deregulation? That was a theme of the previous Trump administration. Expecting more of that.
Yes, the general expectation is a continued push to reduce regulation, probably using executive orders, new agency rulemaking.
Which sectors might benefit?
Areas like banking, the fossil fuel industry, maybe real estate could see lighter regulation. That might also spur some M&A activity, mergers and acquisitions.
But there are risks, too.
Well, EY does caution that the uncertainty around how regulations will change could actually unsettle markets sometimes, as businesses try to figure out the new landscape.
Okay, let's try and bring some of this together. Thinking about all these potential shifts, tariffs, immigration, deficits, what's the overall impact on the inflation outlook?
The key things pushing inflation higher, according to EY's analysis, are mainly those increased tariffs, the reduced immigration impacting labor supply, and potentially larger budget deficits adding to demand.
So their forecast reflects that?
Yes. Their baseline CPI inflation forecast is now about 0.1% higher in early 2026, rising to 0.3% higher by late 2026 compared to their previous estimates. They also talk about a potential bigger shift, maybe moving away from inflation being mostly driven by demand towards supply-side issues having a bigger influence. They mention these structural upside risks, the 5Ds.
The 5Ds? What are those?
Demographics, aging populations potentially constraining labor supply, debt, high government debt levels, de-risking companies shifting supply chains, which might increase costs, decarbonization, the costs associated with transitioning to greener energy, and digitalization, which can be complex, sometimes deflationary, sometimes inflationary. It points to a more complicated inflation picture going forward.
Interesting framework. Okay, finally, let's talk about the Federal Reserve again. What are the implications of all this for monetary policy?
Well, as we touched on, the initial expectation was for the Fed to gradually cut rates through the end of this year, 2024. But now, with this revised outlook, especially the potential for slightly higher inflation due to fiscal policy.
Right, the fewer rate cuts in 2025.
Exactly. EY now sees less easing from the Fed next year, projecting only 100 basis points of cuts instead of 150. It suggests the Fed might have to be more cautious, maybe keep rates higher for longer than previously thought, partly because of these anticipated policy changes.
And what about political pressure? Could the administration try to push the Fed for lower rates?
Well, look, the Federal Reserve is designed to be independent, focused on its mandate of stable prices and maximum employment. But yeah, it's certainly possible the administration might publicly or privately express a preference for lower rates to boost growth.
But the Fed makes its own decisions.
It does. Legally, it operates free from direct political influence on its rate decisions. Now, the president does get to appoint members to the Fed's Board of Governors, and importantly, the chair. The next chance for a new chair appointment is May 2026, when Jerome Powell's current term ends.
And Powell's stance.
He has stated he intends to serve his full term, and he's emphasized the legal protections that exist against a president trying to fire a Fed chair. So the independence is there institutionally.
Okay, one last point. The U.S. dollar. Stronger or weaker under this administration? What's the thinking?
It's interesting. While the previous Trump administration sometimes talked about wanting a weaker dollar, maybe to help exports, EY thinks it's unlikely we'll see sort of unorthodox policies to force that.
So what factors are driving it now?
Right now, things like the U.S. economy generally performing better than many others, and the Fed potentially being a bit more hawkish, meaning less inclined to cut rates than other central banks, those factors tend to support a strong dollar.
And tariffs. What's the historical link there?
Historically, actually, periods of U.S. tariffs have often coincided with the dollar appreciating, getting stronger, not weaker.
Interesting. So despite maybe some long-term concerns about deficits or whatever, the dollar's fundamental role is still strong.
Yes, EY seems to think so. Its position as the world's main reserve currency, backed by the deep and liquid U.S. financial system, that seems pretty robust for now.
Okay, so to summarize for you, the listener, the 2024 election results, they definitely introduced some significant potential shifts in U.S. economic policy. We're looking at anticipated impacts on trade, taxes, immigration, inflation, and yeah, even the Federal Reserve's path.
That's right.
And while the near-term economy seems relatively stable, the more pronounced changes, those seem likely to really show up in 2026 and 2027.
Exactly. And this really leads to a final thought for you to consider. Given these potential economic shifts we've discussed, what kinds of strategies might you, as an individual or perhaps businesses, need to think about to navigate this evolving landscape? And maybe stepping back even further, what broader global implications might these U.S. policy changes have, beyond just the direct economic numbers? Those are really critical questions to keep in mind as we watch how these policies actually take shape and unfold in the coming months and years.